Hello and welcome to our discussion on understanding the cash flows. In today's session, we will try to find cash flows when the balance sheet and income statement are given. We know that the changes into balance sheet at any point of time can be explained by the balance sheet, income statement and cash flow statement. That means one can easily observe that why two items on a balance sheet change by observing the income statement and a cash flow statement. So when balance sheet, opening and closing, and income statement are given, it is possible to find the cash flows, and that is the focus of our discussion. In this session, we will see when opening balance sheet and closing balance sheet are given, an income statement is given, we would like to find the different cash flows. No further information about the transactions given. So the only way we will do is by understanding the relationship between the balance sheet, income statement and cash flow statement. We know that the cash flow statement will show the opening cash in hand, which is 40,000. We'll write down this as CFS, CFO, CFI and CFF, and the closing cash in hand is the summation of opening plus CFO, CFI and CFF, and the closing cash is given as 55,000. So therefore, in this case, we have to find the cash from financing, cash from investment and cash from operation to complete this cash flow statement. Let us pick up one by one. Cash from financing. So cash from financing decision shows the cash inflows, the receipts and payments from all the financing decisions. The financing decisions are raising capital, borrowing money, paying interest, distributing dividends and payback of capital and the loan. And therefore, it is necessary to see the relevant items from the balance sheet. The relevant items on the balance sheet is the change in the capital, the change in the reserves, the change in the debt. By observing the changes in the capital, reserve and debt, it is possible to find whether the business has raised money or paid off money. Let us see that. So we can see the capital has increased. So issue of capital happened here because 25,000 minus 5,000, a change of 20,000, and that too it is issued at a premium because there was no premium in the beginning opening, but there is a premium at the closing. So there is a receipt of money due to the issue of shares at a premium of 30,000. You can see the loan, the long-term loans, there is no change in the long-term loan, so neither issue nor repayment. So the receipts due to the financing decision is 50,000. Now we'll see the payments, and the payments one can find from the relevant items on the income statement is the interest or below the line items, that is the dividends if any. So payments here, we can assume that interest here 3,000 payments, but we can also see whether there is any dividend paid. The dividend can be seen from the reserves. So in this case, the change in the reserves is 70,800 minus 47,000, and this change is fully due to the current profit. So therefore, there is no dividend payment in the current period. So therefore, cash from financing decision is equal to 50,000 minus 3,000, so 47,000 is the cash from financing decision. Cash from financing decision is 47,000. we put that cash from financing decision here. Now we'll find out the cash from investment decision. The cash from investment decision, CFI, the cash from investment decision shows the cash inflows and the cash outflows from the purchase of fixed assets or purchase of intangibles or purchase of investment, and similarly the sale of fixed asset, sale of investment, or the sale of intangibles. So since the balance sheet is given and income statement is given, the relevant items on the balance sheet is a change in a fixed asset, the change in the investments, the change in the intangibles, and the corresponding relevant items in the income statement is interest income, the dividend income, and the profit and loss from the sale of fixed assets and intangibles. Let us go to the balance sheet. So CFI, in this case, we will see plant. The plant has changed from 19 to from 20 to 19. So this change is only because of the depreciation. So that means the plant has not changed because of purchase or because of sale. Whereas R&D, we can see there is no R&D in the beginning, there is an R&D at the end, and there is an R&D amortized, so there is a 60,000 negative. That means you have purchased R&D during the period to the extent of 60,000. Did we receive any dividend? There is no dividend, no interest received, so there is no income from the financing decision, from the investment decision. So CFI in this case is minus 60,000. CFI is minus 60,000. Minus 60,000 is CFI. Now we will focus on CFO. The CFO is a profit generated from the business in the form of cash. So the focus here is the income statement, the profit, and the changes in the working capital. So when we want to find CFO, the relevant items on the balance sheet is the change in the debtors and the stock, the change in the creditors, and change in the outstanding expenses, if any. These are called the changes in the working capital. And the relevant items from the income statement is a profit, depreciation, amortization. We know that we can also mention like this, the CFO is actually an adjusted profit. In other words, it is a profit adjusted for the non-cash items, is an adjusted for non-cash, non-operating items, and it is adjusted for plus minus the changes in the working capital, So if the profit is given and if the relevant balance sheet items are available, it is possible to find the CFO. Let us see that. So PAT is equal to 23,800. We add back the non-operating items, that is interest, 3,000. We add back non-cash items, that is depreciation and R&D amortization. Then we make an adjustment for the working capital. What happened to the working capital? The debtors, we can see the debtors, the change in the debtor here has increased. So increase in debtors, that means we sold the goods on credit during this period. So to that extent, it should be deducted. We see the stock. There is a decrease in stock, decrease in stock, decrease in stock. Stock has also increased. Increase in stock. Increase in stock. So it is 3,000. That means we purchased the goods during this period minus 5,000. Creditors. The creditors has decreased. So it is a payment to the creditors. Decrease in creditors. So we paid money to the creditor, which is a cash outflow. There is an outstanding expense here, increase in outstanding expense. That means to that extent, we have not paid money. To that extent, there is no cash outflow during that period. So if we sum this up, we'll get the cash from operating decisions, that is 28,500. So I put the 28,500 here. Now if you sum this up, we should get the closing cash in hand, which is 55,500. So given the balance sheet and an income statement, opening and a closing balance sheet, an income statement for the period, it is possible to find the cash flows, financing, investment and operating by understanding the relationship between the balance sheet and income statement. In our next session, we will try to answer the question, what is this free cash flow and how different is the free cash flow from the cash from operation. Thank you very much.